Hey everyone, and good afternoon. I'm Lance Davis, Bankrate's editorial director, and thanks so much for joining us for our webinar today. As everyone knows, things are changing really fast these days, and the state of the economy is no exception. The market was hitting all-time highs recently before a sell-off over the past few days. The U.S. continues to add jobs, so the pace may be slowing a little bit, and we've had some recent stimulus measures to discuss. So I want to get the perspective from Greg McBride, CFA, Bankrate's chief financial analyst, on what all this means for you. Greg, if you're not familiar, has nearly a quarter century, not 100 years, a quarter century of experience as a personal finance expert and has appeared on countless media outlets talking about the topics we'll discuss today. Greg, welcome, and how are you?
I'm doing great, Lance. Thanks for having me.
You bet. So looking forward to asking you some more questions, but before we get started, I want to give people the rules of how this is going to work. If you're joining your first Zoom webinar today, you're all on mute. If you do have questions, though, do me a favor, find the Q&A section on your Zoom screen. The Q&A section, I want to make sure that you know that it's the Q&A section where you'll ask the questions. You can type the questions there, and I'm going to be monitoring those, and we'll ask Greg when we get to the Q&A portion. Additionally, we have two more experts who are going to be joining us today, and they're going to be submitting typed responses to your questions. So we'll have Greg answering on camera, and then to make sure we get to as many questions as possible, we have Mark Hamrick and Ted Rossman both in the comments answering your questions as well. Mark is Bankrate's Washington Bureau Chief and Senior Economic Analyst at Bankrate. He's an expert on the economy and a range of other personal finance topics. Ted is a credit cards industry analyst for Bankrate, and he has a deep knowledge of the credit space and is also a great resource for personal finance information. Lastly, before we get started, we'll be emailing a recording of this webinar to you after it's completed. So if you missed something, you'll be able to go back and watch the whole thing. All right, Greg, you ready to answer some questions?
I'm ready.
Okay, well, let's talk stimulus and some related topics first. A lot of people are wondering about a possible second round of stimulus checks. Politicians in DC negotiating a deal as they come back from their August recess. Don't want to get too much into the political aspect of this, but what did we learn from the first round of stimulus that may show how this will benefit people the second time around?
Well, one of the things that we had seen when the economy first started to reopen is we saw a pretty robust bounce back in activity, specifically different areas of consumer spending. Now, a lot of that consumer spending was fueled by the fact that people had money to spend. The stimulus checks, the enhanced unemployment insurance, all of that really kind of helped power that consumer spending and keep the economy, on a recovery trajectory. There's a lot of concern that since that expired at the end of July, what is that going to mean to consumer spending, particularly those that were receiving unemployment assistance that may have seen that drop off or just have uncertainty about how much they're going to get in the months ahead.
Right. So on the topic of economic relief, Trump's executive order from early August, it included unemployment benefits, a payroll tax deferral, potential help to halt evictions, and student loan forbearance. Still a lot of uncertainty and unanswered questions about how this is going to be put into place and executed. But from a consumer perspective, how badly are these needed right now?
Well, I mean, on the unemployment assistance, I think there's, a lot of people that, since July 31st, they've seen their unemployment income really drop off. Now, there's some evidence that we are seeing people come back into the labor force at a faster rate. Was one of the things we learned from the jobs report. But there are still a lot of people that they're wondering how they're going to make ends meet because, that additional $600 a week federal on top of what they were receiving at the state level, really made a big difference. And without that, they're wondering how the bills are going to get paid, or they're very rapidly running down their savings. So any little bit in that area helps. I think that, putting some of that burden on the states might make it a little more complicated given the state of their budgets. The student loan forbearance, I mean, just like any other creditor, getting some relief from payments if you're out of work, if you've seen a hit to your income, that can really bridge the gap and kind of get you from here to there without falling further behind. That one's sorely needed. The payroll tax deferral, I mean, it's what you said, it's a deferral. It's not forgiven, it just puts that off till next year. I don't know that that's tremendously helpful, simply because it does have to be paid again next year. And it creates, I think, some potential headaches for employers that might make them reluctant to institute it, right? Because not only do they have this sort of paperwork and technical side of it they got to go through now to make it effective, but then they're also on the hook for those payroll taxes if, say, the employee isn't around after the first of the year when it would be repaid. So, some of that I think is definitely sorely needed and definitely a help. I would like to see something that is targeted not just toward those that are unemployed, but those that have seen a hit to their income. Half of American households have seen their income take a hit since the pandemic began. So it's not just those that are unemployed. There are a lot of people that are working. They're just making a lot less. Something that would put money in their pockets and enable them to sustain spending, stay current on bills, I think would go a long way in this recovery.
Yeah, and speaking of the jobs picture, we had the August jobs report released last Friday. We added 1.4 million jobs in August, and the unemployment rate fell to 8.4%. The jobs number, 1.4 million, that's a big number, but it's down from previous months and ultimately still down 11.5 million since the coronavirus hit. So Greg, what do you make of the jobs picture today, and are you concerned about the slowdown from month to month?
Well, we've recovered a little less than half of the jobs that were lost in the initial stages of the shutdown in the past several months. But, like dropping a basketball off of a 7-story building, the biggest bounce is the first one, right? After that, it loses momentum pretty quick. So, getting back that next 11.5 million jobs, I think is going to take a lot longer than what we had seen here for the, recovering the first 11.5 million jobs. That coupled with, I think, weak demand that you see, the ongoing uncertainties about the virus, and even health concerns, people, that are reluctant to spend, particularly if it involves being out and around other people. I think all of those could be headwinds, not only to the economy, but ultimately to the job growth that we see.
Absolutely. Want to pivot here a little bit to the housing market. Housing's been an interesting space to watch over the past few months. It snapped back in a really big way in July at about 1.5 million housing starts. New home sales hit over 900,000 in July. That's not just up month over month. That's up 36% year over year, like way before the coronavirus hit. What's going on in the housing market right now, Greg?
Well, there's not a whole lot of economic bright spots, but this is one of them. I mean, housing really sort of powering much of what we're seeing in the recovery. And for a few reasons. One, you had a lot of pent up demand. People that, the spring buying season wasn't. That got deferred. So we're kind of seeing that pent up demand. You've got record low mortgage rates. So that certainly helps home buyers, puts a little wind in their sails from an affordability standpoint. And then you have all those people that were locked down at home for 2 months and realized that, hey, this setup just isn't going to work. We need something else. So whether it's, moving out of urban city centers into suburban areas where they can work from home, or just getting a different space that's more conducive to working from home, schooling kids at home, that kind of thing, we're seeing a lot of movement as a result. So I think housing is definite boon and definite plus for the economic recovery, at least through the first quarter of next year. Kind of a question mark at that point, because as those CARES Act forbearance programs start to roll off, I think that could certainly be a drag on housing. How much we'll have to see.
Sure. And there seems to be a lot of buyers in a lot of these markets and not so many homes for sale, and that's kind of driving up prices in a lot of areas. So for buyers who might find themselves in a bidding war, what's your advice for them?
Well, maybe it's just my value conscious side. I just think if you find yourself in a bidding war, tread carefully. And I just, what I've seen a lot is, the euphoria about that house is never higher than the day you move in. After that, the euphoria wears off, the payments do not. And so I just think you have to be careful if you're getting yourself into a bidding war, if you're, putting yourself on the hook for bigger and bigger payments. What I've seen is, people that, we're all gung-ho to get into a house. After 3 years, 5 years, 10 years, the novelty has worn off, the payments have not. Now they start to resent it because, well, I got to repair this, got to fix that kind of thing. And I just, so I would just, kind of consider that big picture to the extent possible. And like I said, just tread carefully so that you're not overpaying.
And so historically low mortgage rates have been playing some role in all of this too. Doesn't look like rates are going to increase anytime soon. So what has to happen for home prices to come down in some of these areas?
Well, right now you've got an imbalance between supply and demand. As you noted, right, the demand among home buyers is high, but the supply of homes available for sale is really low, and it's lower than it even was pre-pandemic, right? This problem's not new. It's been around for a few years. It's just worse now. And so what's going to change that? you get a change in that balance between supply and demand. Now, in some areas, you're going to see that, as people, particularly in areas where people are moving out, all of a sudden there's not going to be a problem with supply. So I think those are the areas where prices might be most sensitive. But a lot of other areas, particularly the suburban areas where people are moving, lower cost areas, even Sunbelt states, that I think that dynamic, that imbalance between supply and demand is not something that's going to be fixed anytime soon.
So for someone who is looking to buy a home soon, what can they do to give themselves the best chance to find and land that house in today's really hot market?
Well, I think that from a personal finance standpoint, the steps you take first, get your credit in order, pull copies of your credit reports from each of the 3 major credit bureaus, make sure that there's no incorrect information on there that could torpedo your credit score, because if that happens, you're not going to get those great rates that are out there. The other thing is use a calculator like we have at bankrate.com to figure out how much home you can afford. Use that as your boundary when you're home shopping. That will, I think, alleviate this tendency to stretch that can often happen and leave people in a position where they might be house rich but cash poor. And then get pre-approved for a mortgage. Particularly in a tight market where the potential for bidding wars is there. The second best thing to being a cash buyer is having a firm mortgage offer in hand. That could make the difference as well.
Got it. We have a couple viewer questions that are related to this, so I'll go ahead and get to them now. Juanita asks, how much are investors impacting this housing market?
Well, that's nothing new either. This is something that, really ever since the bottom of the foreclosure crisis, a lot of the buyers that have come in and bought in bulk are, large investors buying houses and then renting them out. And so that further diminished that supply of homes that are on the market. And the rental market is, by and large, been pretty good. So, that's not something where you're seeing investors looking to exit the market. So it's not going to alleviate that supply issue. If anything, it may only exacerbate it.
And Carol Dukes asks, is that something that will eventually pop? I think referring to just how hot the housing market is.
Well, there are limits from, in terms of the payments that people can make, whether they're renting or buying. And so, I would, that is ultimately the ceiling. But I don't know that we're necessarily there yet. Keep in mind that those low mortgage rates, they do put a little buying power behind home buyers. Gives them an ability to bid up a little bit more than they would have when rates were higher. The plus is that we're not seeing the crazy lending that we saw back in the housing boom. So you're not seeing home values go up as a result of just stupid money flowing everywhere. But that doesn't necessarily mean home prices are going to come down. It just might mean that once they level out, they kind of flatline for a while rather than pulling back.
Got it. So thank you both for those great questions. We'll get to more throughout the Q&A. A perfect segue here. Jeeves asks, will the new fee to refinance kick in this December? Greg, I want to get your thoughts on this, and we'll get to that specific question in a second. But it's a 0.5% fee on refinances through Fannie and Freddie. They pushed back the start date to December 1st rather than the initial September 1st. My question is, why are they even doing this, Greg?
Well, first of all, this thing, just the way it was initially announced, just didn't pass the smell test. I mean, it was, dropped on the market with no announcement. It was something that, literally you wake up the next morning and the pricing has changed if you hadn't locked your rate because of the way this was announced. And so it was one of those situations where you had both borrowers and lenders on the same side screaming at the regulator of Fannie Mae and Freddie Mac about, why are you doing this? It's nothing more than a money grab. And their original rationale for putting it out there just didn't make any sense. They said, oh, it's because of risk. Well, I won't go off on a tangent, but that just didn't make any sense. Now, they've since sort of clarified in a way that makes sense. I don't know why they just didn't tell the truth from the outset, but they said that this is a fee to cover the cost of all the forbearances that are in place. Okay, that makes sense. Don't know why you didn't just say that from the get-go, but whatever. So yes, this is put off until December the 1st, but I think what you're going to start seeing is that lenders are going to start pricing this in no later than mid-October. And in some cases, lenders that have a larger backlog and it's going to take longer to get people to the closing table, pricing might reflect that higher fee sooner. So there's a real, I think, sense of urgency to act now in terms of refinancing, not just because mortgage rates are at record lows, but get in under the wire and avoid that fee.
Yeah, it's a really, really tough deal for consumers looking to refi. Greg, like I said, they've pushed this back to December 1st, although, like you said, they may be pricing this in already. But is there any chance they just change their minds and decide not to put this into place?
Well, we can dream and hope, right? I wouldn't bank on it. Aside from the fact of all the forbearances that are out there, and that that comes at a cost. I'm again not real happy that you're piggybacking on the back of homeowners that are looking to reduce their monthly payments and generate meaningful monthly savings. But aside from that, there's a lot of pressure for Fannie Mae and Freddie Mac to kind of build up the coffers so that they can get off the taxpayer dole. They've been under conservatorship since 2008 and become self-sustaining enterprises. Again, not real thrilled with the fact that they somehow feel they have to do that on the back of the homeowner who's looking to refinance. But for those reasons, I wouldn't hold my breath that it's going to go away. Or maybe we just take our December 1st postponement and live with it.
And a good follow-up question here from Bonnie. She asks, is this something that, they noted the forbearance issue as a reason for this? Is this a fee that we think is going to stay beyond the COVID situation? Like, once this forbearance thing kind of eases off, or are we thinking this is here to stay?
Oh, Bonnie, that is a great question. And here's why. Because listen, if it was just a temporary thing that would go away, when the forbearances, roll off, that'd be one thing, right? But as we saw in the financial crisis, there's a precedent for this. There were loan pricing adjustments made post-financial crisis to compensate for all the delinquencies, defaults, and things like that. Those are still there. They never went away. And so that's that precedent that kind of concerns me, is that these things get layered on, but they don't go away when the problem passes.
Right. And then another viewer has a question very similar to my final question on this topic. When the refi fee does kick in, will it kick in even if you refi or lock in your rate before December 1st?
Well, that's the beauty of locking in your rate. When you lock in your rate, you've locked in that pricing. If you're not locking your rate, if you're letting that float, that's where you're subject to a change where, much like people saw, the day after the fee was announced, they woke up in the morning, they hadn't locked their rate. Bad news, the pricing changed. Now they were stuck with the fee. If they'd locked their rate, they were immunized from that. So that's really the key ingredient. And I think, again, is why it really pays to get this process started now, so that you can get along with the refinancing application process and the loan approval, get your rate locked before that fee starts to be reflected in loan pricing.
Yeah, absolutely. The deadline is December 1st, but the refi process takes a lot of time, and definitely want to get moving on that if you're still looking.
Yeah, and the significance of December 1st, just to be clear to everybody, is that is for loans delivered to Fannie Mae and Freddie Mac beginning December 1st. So doesn't mean, for closing at that point in time. It's what determines it is when the lender actually delivers that loan to Fannie Mae or Freddie Mac. So getting closed well in advance of December the 1st is really key to avoiding that fee.
Absolutely. All right, we'll switch gears and talk the stock market, which another interesting space here over the past few months, and especially recently. Stocks have been on a steady climb since the markets plummeted in March. There's a big sell-off at the end of last week, but believe it or not, S&P is still positive for the year, at least when I checked not too long ago. The Dow isn't quite positive, but has ripped off some big gains since March. Greg, what's the biggest takeaway that you have from the past few months when it comes to the investing markets?
You have to be in it to win it. I mean, all of this volatility that we have seen this year, I think really illustrates the folly of trying to time the market. In that, yes, we saw an unprecedented plunge from February 19th, which was then the record high, till about the third week of March, as the pandemic really took hold of the global economy and the U.S. economy. And at the time, nobody foresaw that we were going to have this rapid snapback. Well, if you panicked and you bolted in early March and have been sitting on the sidelines ever since, you saw that market not only recover all those losses, but then go on to extend gains. And so again, I think that, despite volatility or, what, catalysts might be on the horizon, it's really important for investors to keep that long-term horizon front of mind so that you don't make decisions based on short-term volatility that can have long-term ramifications on your financial situation. Over time, the stock market has returned, an average of 10% since 1926. But if you miss the market's best days, just a tiny fraction of all days, but the best days, your return is significantly lower than that. And yet those best days often come on the heels of the worst days. And we've seen evidence of that here in 2012.
Absolutely. September, historically a rough month for markets. And then you obviously have the election on November 3rd. So plenty of uncertainty in the next few months, and markets tend to usually not, like uncertainty. As an investor, instead of trying to predict what's going to happen to the market over the next few months, how do you approach the months ahead and make sure that you're, investing in a smart way?
Well, valuations are high right now. So, there's not a whole lot of bargains. And that's why I think a pullback similar to what we had seen end of last week, I think would certainly be welcomed. I think it would, bring more money off of the sidelines, because people that are, afraid of buying at record highs might be a little bit more inclined or feel a little bit more comfortable if they saw the market pull back 10% first. But no guarantee that that's going to happen. I think you got to, again, maintain the long-term perspective. If you're waiting for world peace and harmony before you invest, you're never going to invest. Investing involves risk, and you just have to be kind of comfortable with those short-term gyrations. Another way to approach this is do what's called dollar cost averaging. Invest a set amount of money on the same schedule every single month, and that way you don't have that regret of putting all your money in at once and then seeing the market go down the next week or something like that. You can kind of, dip your toe in the water slowly.
So last topic before we open it up for questions, we have a ton of questions in the Q&A, which I'm excited for. But I want to quickly get an update on deposit APYs. This isn't a surprise. We've known for months now that banks would be lowering yields on their savings and CDs. For these products, what do you deem competitive these days, Greg?
Well, right now for something like an online savings account, I think something in the 0.7 to 0.9% range is, as good as you're going to get. And there's no guarantee that that's necessarily the bottom. They might drift a little bit lower. I don't think it's worth gaming it for 10 or 15 basis points. I think what is worth gaming is if you've got your money parked at a bank, particularly the larger banks that are paying 0.1% or something less than that, that's when you need to move the money into an online savings account. You're still going to earn 7, 8, or 9 times as much in the way of interest, even at today's low rates. But, I wouldn't focus so much on jockeying between, one high yield savings account and another in an effort to squeeze out 5 basis points, because some of those yields may still trend lower.
Yeah, related to that, we have a question from Sherry Foreman, who has an online savings account with one institution. The rate is down to 0.6%. All the way from 2%, which is, she calls out a specific bank, but that's common for a lot of banks that were offering high yield savings accounts over the past year. Is that a good enough range where you feel like maybe, sure, shop around, but, it's maybe if you like the institution, maybe it's worth keeping it there?
Here's the thing. The way the math works, if you say, this 0.6, I can do better. I can get 0.85. And then you go to move the money, the days that you're out of that account altogether and that money's in transit and you're earning no interest, it takes a while to make up for that based on, a 20 or 25 basis point differential. And that assumes that the account you're moving to doesn't come down in the interim or shortly thereafter. And so that's why I think, it's kind of splitting hairs in a way with rates this low to kind of chase one high yielding account versus the other. 0.6, you're still half a percentage point above the average savings account. So, you're still in what I would deem, a very competitively priced account.
So Gary Smith notes that CD rates are very low. Where's a good place if you're looking for a little bit more yield, but also some safety, or is there a place like that to keep your money?
Well, there's a relationship between risk and reward. And, if you're not willing to take any risk, you have to settle for low returns. And, if you're you have to have higher returns, well, you better be comfortable taking risk, because that's what it's going to, take to get that. CDs are a risk-free investment. They're governed by federal deposit insurance. And so, right now, if you go all the way out to a 2-year CD, the top yields are around 1%. So there's just not a whole lot there. If you're trying to squeeze out more yield than that, you have to be careful about taking on risk. One option that does exist are what are called rewards checking accounts. These are accounts that can pay higher returns, 2.5, sometimes even 3%, up to a certain amount, usually somewhere between $10,000 or $25,000 as the max. But you got to meet certain requirements every month. You got to pay bills online. You got to get direct deposit. You have to use your debit card at least 10 to 12 times a month. Those kind of things. Any month you don't clear those hurdles, you don't earn that rate of return. So it's something that for people that this is stuff they're doing already, that's going to fit like a glove, and that could be an easy way to boost some of your return. But short of that, you just kind of got to take what this low rate environment gives you and resist the urge to venture into riskier investments in an effort to earn higher returns.
Yeah, we've seen in years past a low rate environment. It really, punishes savers. The Fed last week made a big policy change. Maybe didn't, make headline news, but for folks who are, into the Fed and monetary policy was major news. Agreeing to average inflation targeting. For people who, may not, follow the Fed too closely, what does that mean for consumers?
Well, let's boil it down. I mean, basically it means interest rates are going to stay lower for longer. That, once inflation starts to pick up, the Fed's not going to be in a hurry to get off the couch and go chase it down. So if you're a borrower, that's good news, because it means not only are today's low rates, today's rates really low, but they're going to stay low for the foreseeable future. For savers, as if low rates didn't stomp on your foot, now you get kicked in the knee, because the Fed is basically saying, hey, in addition to those record low returns, even once inflation starts to pick up, we're not going to be in a hurry to rein it in. So, it's a double whammy for savers.
Yeah, for sure. All right, we're ready for the Q&A portion. Are you ready, Greg?
I am ready.
Okay, let's do it. First question from Betty Highland. Is it smart to include closing costs and other fees in a refi if you are not taking out equity?
That's a great question. A lot of people, we're talking about a significant, chunk of change. This is, a few $1,000s whenever you're refinancing. If you've got the equity where rolling those costs in is not going to put you above a key threshold like 80% loan to value, or not going to push you above a key pricing threshold. For example, some lenders offer a better price below 75% loan to value. Factor those things in. But yeah, just to kind of preserve what limited cash resources you have. And yes, you're going to finance those costs, but you're financing those costs at today's record low rate. So I think what really ultimately determines that is, what's going to be your resulting loan to value, and what's the implication for pricing on that.
We'll stick with the refi theme. Niranjan asks, I refied earlier this year at 3.25% and am now considering at 2.5 or a lower refi if they can get a better rate. Does it make sense to refi twice in a year, even if they're planning to stay in the home for more than 5 years? So a lot of numbers. So if you need me to repeat anything, let me know.
Well, look, the previous refinance, that's what's called a sunk cost. It's already done, right? So now it's just a matter of evaluating, does another refinance benefit me? And if you can knock that rate down by 0.75 of a percentage point or even more, it's worth considering what you're doing. If you're going to be in the home longer than 5 years, that's the type of time frame where you can not only earn back those costs, but begin to accrue the benefits of having refinanced. So yes, I would certainly not discourage you from looking into it. I would encourage you to run the numbers. If you can get a break-even period of 2 or 3 years, and that coincides with that horizon that you still have, then yes, it could pay for itself quite nicely.
A couple of questions. The one I'm seeing right now is from Roberto on credit scores needed to get the best interest rate. So Roberto asks, what is the ideal FICO score to get the lowest interest rate? And also what is generally competitive right now in terms of interest rate?
Yeah, typically credit scores above 740 get you the best rates. In some cases, like a mortgage, some lenders may require something above 760 to get the best rate. But bottom line is, once you're above that threshold, there's no better pricing tier available. So obsessing about whether your score is 790 or 800 is kind of a waste of time in that respect. So, competitive rates are available really for credit scores 700 and up, but to get the best rates, you typically want to be above that 740 level.
All right. John Jensen asks, am I correct that the 0.5% fee only applies to mortgages and refis of more than 125,000?
That is correct. 125,000 and only those being delivered to Fannie Mae or Freddie Mac. So if you're getting a VA loan or an FHA loan or a larger jumbo loan, no, you don't have to worry about that fee. Of course, in some cases you're paying other fees or higher rates to begin with.
Tyler asks, does the new fee apply to VA loans? And is there any value in buying down the rate that most lenders seem to offer, but appears will cost more in the long run?
It does not apply to VA loans. And that idea of buying down the rate, I mean, what you're effectively doing is prepaying the interest. And so this is another one where the longer you're going to be in the home, the longer you're going to have that loan, the more you will benefit by doing so. And so, there's kind of a balancing act between, how much cash am I willing to part with, without restricting my financial flexibility in order to buy down that rate? And then how long does it take me to earn that back and really start to accrue the benefits of it? It's typically several years down the road. So I think you want to be very cognizant of how much you're paying and what you're getting in return for that.
So we'll answer some investing and saving questions now. One viewer asks, should we invest in a 401k or stocks? And Greg, there's probably a little confusion there to clear up.
Yeah, I mean, a 401k, much like a 403b, for example, this is a workplace retirement savings program where you can contribute directly from your payroll into your retirement account on a tax-advantaged basis. So within that 401k, you have then a menu of options in terms of how you want to invest that money. Stocks being among those choices. So let me break that question into two parts. Should we invest in our 401k? Yes, absolutely. This is an easy way to save for retirement because it comes right out of your paycheck. You can do so on a pre-tax basis and reduce your taxable income today. Many employers also offer a Roth 401k. So even if you're putting in after-tax money now, you can withdraw it tax-free in retirement. Many employers also have an employer match, which basically amounts to free money. So check, check, check. Yes, you definitely want to contribute to your 401k or employer-sponsored retirement savings plan. And then within that, how do you want to invest? Look at something like a target retirement fund. This leaves that decision of how to divide the money between stocks, bonds, and other investments to the professionals and not having to figure it out for yourself. And, before you, kind of shrug that off, 90% of investors' returns over time, it's been shown in studies, comes from the decision of asset allocation. How much am I putting in stocks? How much am I putting in bonds? How much am I putting in cash? Having that responsibility on somebody else's shoulders who's going to take care of that, I think is a huge boost for, the average individual investor, where all then they have to worry about is just keep putting that money in and make sure that they're on target.
So another viewer has a question about 5-year CDs. This person has found a rate around 1.8%. So I guess I want to just get your thoughts on where or how 5-year and other long-term CDs fit into someone's saving strategy in a time like this.
Well, where they fit in is, let's say you're somebody who's been retired for a number of years and you've had this laddered portfolio of CDs where you've got a bunch of 5-year CDs, but they're structured that they mature every year. You have a different one maturing every year, and then you roll over the proceeds that you don't need into another 5-year CD. That's where, keeping with that laddered structure can be a benefit. Yes, rates are low, but by virtue of having that laddered structure, you've basically diversified over a range of maturity dates. Where I don't think they make a whole lot of sense is, you want to put money into a CD and you look and you say, oh, I can get a higher return on a 5-year CD than I can on a 1-year CD. Let me put the money in the 5-year CD. Because what you're basically doing in that case is you're marrying yourself to that 1.8% return for the next 5 years. For the next 5 years, inflation's probably going to run higher than 1.8%. So you're going to lose your buying power, and that money's tied up. You've restricted your financial flexibility. If you want to get into that CD prior to maturity, you're going to pay an early withdrawal penalty, which in some cases, little known fact, if the accumulated interest that you have is not enough to satisfy the penalty, it can cost you some of the principal. which is the exact opposite reason people invest in CDs in the first place. So not a huge fan of venturing into the longer term CDs as a way to, eke out a little bit of extra yield.
Rochelle has another question on CD rates. She's noticed that rates are lower for longer term versus shorter term CDs. I personally haven't seen anywhere the longer term are shorter, but they have gone very close. So where do short term CDs kind of fit into this?
Well, there is typically what's called a yield premium in the form of, longer maturities, typically earn higher rates. That advantage has really been compressed, and not just in CDs. You see it in government bonds, you see it in a lot of other different types of bonds as well. So that advantage has really been squeezed down. And then that kind of goes back to what I was saying a moment ago in the last question about, there's not a whole lot of advantage to stretching into longer maturities just to eke out a little bit of additional yield, because there's not a whole lot there. You got to lock that money up for a lot more time to get any kind of additional return. Short-term CDs give you a lot of flexibility. I mean, with very little difference between yields on short-term CDs and long-term CDs, you're not giving up much in the way of yield by sticking with the shorter maturity, but in so doing, you've retained more financial flexibility because that CD is going to mature sooner and give you the ability to either reinvest it in CD or just give you access to money that had previously been tied.
Nikki writes her question in, if I have a big chunk of money, should I use it to pay down my mortgage or invest in mutual funds, stocks, some other type of investment?
Well, before you look to pay down the mortgage, look to see if you're maximizing those tax advantage retirement savings options. Are you maxing out your employer's 401k? Are you maxing out your IRA contributions every year? And if you're age 50 or up, you get to make even higher annual contributions because of what are called catch-up contributions. Look to utilize those to the full extent. Other things that are higher on the pecking order are paying off other higher rate debts. Just as a really obvious example, if you're carrying credit card debt at 14%, paying that off is a risk-free return of 14%. You can't beat that, right? So, kind of go through that checklist. If you've done all that and you're still, you're maxing out your retirement accounts, you don't have, any other higher cost debts, then it's a decision of pay down a low rate, typically fixed rate mortgage. That's a risk-free return, or invested in something with a higher rate of return that does involve a little bit of risk. I'm a big fan of, the latter, all else being equal, paying down a low fixed rate mortgage is kind of a low financial priority, and that money's tied up. You can't get to it if you need it. Where that really pays benefits is whenever you pay off the mortgage altogether, and now you've created a lot of breathing room in your budget. So, where I'm a fan of paying ahead on the mortgage is you get down to the last $10,000, right? Hurry up, get it paid off, and now you've got this big monthly savings. But for somebody who's 20 years away and they're hoping to shave a couple of years off, you're going to limit your financial flexibility by tying up that cash, just in an effort to pay down the mortgage.
Another viewer has her stimulus check. She's wondering, should I invest that money or put it into savings? So how should this person kind of think through that decision?
The first question is, what's your savings look like now? The majority of Americans are short on emergency savings. And, particularly in an environment where, we have unemployment still up near 8.5%. It pays to boost that emergency savings. We really don't know what's going to, lays around the corner economically. So I think for most people, that's going to be the answer. If your emergency savings is adequately funded, you don't have other higher rate debts, then yes, at that point, you've got the green light to be able to invest and, have a longer time horizon with that money.
John Owendorf asks, what's the best instrument for a good return, but continuing to have some level of liquidity?
It kind of gets to that, people say, I want to earn a really high rate of return, but I don't want to take any risk. And my answer to that is, yeah, me too. If you find it, let me know. Just because, typically it doesn't work that way. If you want higher returns, you've got to be willing to take some risk. If you're not willing to take risk, you're going to have to settle for lower returns. So liquidity typically comes at a price. That's why in most environments, savings accounts earn less than CDs, because that money's liquid. You can get to it at any point, as opposed to a CD where you're tying that up. I mentioned rewards checking accounts earlier. Those are accounts that can pay higher yields if you meet certain requirements every month. They are fully liquid. They are federally insured. That would probably be your best avenue without venturing further out onto the risk spectrum.
So we'll go back to some refi questions. Tim Curley asks, how can I shop for a refinance rate without getting a number of hits on my credit reports and subsequently lowering my credit rating?
Well, first of all, the way that the credit scoring models work is, they ignore all of your inquiries for a mortgage within the last 30 days. And then they aggregate the ones that came for the 30 days before that as one inquiry, because people typically aren't, you may go out and open up multiple credit cards at once, but you're not going to go out and take out multiple mortgages, right? So, you're not punished for shopping around. And that's the moral of the story. You're not punished for shopping around. Just do so in a concise time frame, so that those credit inquiries are aggregated as one, and so you get an apples to apples comparison on the pricing. Rates change all the time. You want to do that comparison shopping within a narrow window of time, so you're truly comparing on an apples to apples basis.
So we have another question from John, and I'm asking this one in kind of bucketing it with some similar questions. But what's a reasonable rate for a refi, and kind of how do you balance the rate versus how many years you have left on your loan when you're making that decision?
Yeah, and with the rate, there's a lot of variables that come into play. We throw around these numbers like 3%, 2.5%, mortgage rates, but even that, it kind of comes with certain parameters, right? That assumes it's a primary residence, that your loan to value ratio doesn't exceed 80%, you've got a credit score of 700 or better, those kind of things. So that being said, and some of it pertains to the product itself. So the 30-year fixed is kind of the lion of a mortgage market. That's where most loans go. Shorter term loans have lower rates. A 15-year fixed has an even lower rate. So let's say you're 8 years into your first loan. You got 22 years left on this 30-year fixed, and you're looking at refinancing now. You've got a couple of options, right? You can refinance into another 30-year fixed and preserve your flexibility to still pay it off in 22 years if you want, or dial back the payments if money gets tight, right? Because you can take up to 30 years. Or you might say, yeah, the payments aren't the problem. I'm just closing in on retirement. I want to get this thing knocked out. Well, maybe look at a 20-year or a 15-year when you refinance. Your payments won't go down as much. If you really shorten the loan term, the payments might actually go up, but you're shaving off years off of the loan, saving yourself years worth of loan payments, and that's where the interest savings comes from.
So Mario asks, is it smart to refinance a reverse mortgage?
Reverse mortgages work a lot like forward mortgages in the sense that, there's an interest rate that's charged. And yes, you can look into refinancing that just as you would with a traditional forward mortgage. That's refinancing is geared to the same purpose, reducing the interest costs. That's going to reduce the interest that accrues over the life of that reverse mortgage.
Barbara asks, how do you determine the combined credit scores for a married couple if you're looking to refinance?
What lenders typically do is they pull credit scores from each of the credit bureaus for both parties, and then they typically look at the lowest score. So, if there's a real mismatch in credit quality, that's something that could hurt you at loan qualification times. Otherwise, for those whose credit scores are both in good shape, there's not a whole lot of reason to obsess about it. More gets at bragging rights and everything else. They used mine, not yours.
Lords asks, what's an adequate amount for an emergency savings account?
I think for most people, the typical amount is going to be enough to cover 6 months worth of expenses. If you're a sole breadwinner, you own your own business, probably going to need more. You might need 9 or even 12 months worth of expenses. Now, that's a big number, right? It's a destination. It's not a starting point. Don't feel bad. Only about 1 in 4 Americans actually has enough to cover 6 months of expenses. But what I think is critically important is regularly contributing to that emergency savings, ideally every payday through direct deposit, so that you're constantly feeding and replenishing that emergency savings. Expenses come along, kind of runs the balance down. You're only 1 paycheck away from replenishing that. And again, it's a destination, not a starting point. What we do see among those that do have adequate emergency savings tends to skew a little bit older. Why? It takes time. And, in the early years, that amount is a moving target. Your expenses are going up. And so you're never quite getting there. Yeah, sure, it's going to take time, but having that habit of regularly feeding the savings account kind of puts you a little bit closer each day, puts you on firmer financial footing.
Latoya asks, are high yield online savings accounts a good way to start your savings, both just in general savings and emergency savings?
Well, especially for emergency savings. Everybody needs emergency savings, and there's no better place to put it than in an online savings account. That's where you're going to get the best returns. It's federally insured. You can get to the money whenever it's needed. You can link it to your existing bank account and move the money back and forth as you need. So it doesn't, it's a supplement to, not a replacement for your existing banking relationship. So yes, when you're talking about emergency savings, that's the place to start. In terms of saving for other goals, a lot of that depends on the time horizon, right? If you're saving money for a down payment on a car or a home that's a year or two away, online savings account, maybe short-term CD could be the place to put the money. You're saving for retirement, something that could be years or even decades away and decades in length, then savings account not going to cut it. You need the higher returns that come with riskier investments to compound that growth over time and get you the nest egg that you need. So that's where you need to look more towards stock market index funds.
So Amanda has gone from renting to buying. So congratulations, Amanda. She asks, what's your advice for rebuilding a savings account after paying for the down payment and other new home costs?
Yeah, this is where that habit of that direct deposit, regularly feeding money every payday into that emergency savings account is really kind of the best way to build it back up. There's other things that you can do to kind of, supplement that or really even little tricks that you can use to kind of fool yourself into putting more money into savings. Anytime you save money on coupons, for example, put that amount in the savings. Any unanticipated income, you get a bigger than expected commission check, you get a bonus check, you get a tax refund, put it in the savings. If you're paid every other week, there's 2 months out of the year where you're going to get a third paycheck in that month. Most months you're living on 2 paychecks. 2 months out of the year, you're going to get a third paycheck. Well, there's an opportunity to put money, a whole paycheck, in savings. Not going to be able to do it right away. You might have to do it over the span of a few months, but bottom line is there are opportunities to not only feed that account regularly, but then take some big strides when you get some unanticipated income.
Another viewer is saving for a down payment and asks, what type of account should I save the money in? I've heard money market accounts. Others have said just regular savings. So what do you say, Greg?
Well, money markets and savings are kind of 6 of one, half dozen of the other. Money market deposit accounts are also bank accounts that are federally insured. They're just like savings accounts. You can get to it when you need it. What I would stay away from are money market mutual funds. This is something that's, say, available through your brokerage account. They're not federally insured, and the yields are dreadfully low. They're even lower than some of the bank savings accounts. Look for a federally insured online savings account or money market deposit account. We do have a list on bankrate.com of all the top yielding accounts. That's the place to.
All right, I want to ask a credit question. We have a credit question from one person who asks, have economic conditions improved to a point where credit card lenders will soon offer attractive bonuses and loosen their underwriting to approve new customers, or is that just pie in the sky?
I don't think it's pie in the sky, but I don't think we're there yet. But listen, right now, credit card issuers, they've kind of been in this, risk management mode. They don't really know how bad the defaults are going to get, and so they're kind of doing, their own version of social distancing in the sense that they're not looking to take on more risk, and they want to, just kind of limit their book to customers they know. And so I think what you're going to see going forward are offers that are very targeted, targeted to consumers with higher credit scores, targeted to consumers that have other relationships with the financial institution. Yes, those deals are going to come back, and they will come back, over time. It's not pie in the sky, but we're still, I think, kind of early stages in the sense that the big question mark credit card issuers have is because of all the forbearance programs and the payment workouts, they don't really know how bad the delinquencies and charge-offs are going to get quite yet. And it's going to be difficult for them to go whole hog on, trotting out new offers, I think, until they get a better handle.
So we got about 10 minutes left. So still some time to answer your questions. So get those in. We've got another question from a viewer who asks, how do you go about choosing the best mortgage lenders? There seems to be so many of them. So Greg, like what kind of things do you look for when you're comparing mortgage lenders?
Well, I mean, so look, some of this is just going to boil down to personal taste, right? I mean, I strongly advocate shopping around because there is a tangible advantage to shopping around and getting a lower rate. Even people that say, oh, yeah, but I really want to deal with a name I know or a familiar name. Listen, a lot of times, 30 days after your loan is closed, it gets sold to one of those big names you're very familiar with. So by the time you start making your payments, that's who you're making your payments to. Only you got the loan through somebody else who gave you a better deal, right? So, but I advocate shopping around because if nothing else, that tells you whether or not the quote that you've gotten from your existing lender is even competitive, right? It gives you an idea of what is out there. Yes, shop based on the lowest cost loan. You look at the annualized percentage rate that factors in not only the interest cost but also the fees that are charged. But other things you want to take into account too are reviews or recommendations. People had good experience with them. Those are things that are maybe a little bit they're not quantifiable as much, but certainly very valuable to a lot of consumers and valuable when you're going through the process, just because it does kind of own you for a few weeks.
Lori, yes, we'll be sending a recording to the participants. Thanks for joining. We'll be sure to send that around. Let's see, coming up with another question here. I saw a question earlier around whether to start investing now versus the end of the year. I think the person probably has some questions around the election and the uncertainty there. But Greg, kind of how do you decide should I just get in now or get in in the near term?
Yeah, I'm not a fan of timing the market. So if that's your thing, like, oh, gee, maybe I'll wait until after the election. Well, do you know for sure the market's going to go down? Do you know for sure the market's not going to go up? Those kind of things, right? Don't get into that guessing game. If you have that sort of trepidation, then you can do the dollar cost averaging, put in a set amount of money on a regular basis, and that way you're kind of tiptoeing your way in. You're not buying all at one point in time and then having that regret if the market pulls back. So if you have that concern, I think that's the way to go. I will say though, statistically, what studies have shown is that you're better off investing in a lump sum than spreading it out over time. But that doesn't consider the emotional argument, right? The emotional argument of, oh man, I put all my money in and now the market's down 10%, right? If you don't want that feeling keeping you awake at night, then do the dog.
Yeah, definitely know yourself before making that decision. Terry Culp asks, I recently retired, so should I continue to contribute to my retirement account?
Well, it takes earned income in order to be able to contribute to a retirement account. So without that earned income, you're not going to be eligible to do so. If you have other resources that you can live on and not needing to tap those retirement accounts, that's a worthwhile consideration because that money grows on a tax advantage basis. The only thing you want to be mindful of is that at age 72 and a half, you'll be required to start taking required minimum distributions from those tax deferred accounts, like a 401k, money that was put in our pre-tax basis. Reason being, Uncle Sam wants his cut, right? They're only gonna let you put it off so far before they want to start taxing that money. So you do have to start taking money out of a certain age. You don't want to put everything off until that age and then you turn 72 and a half. And now you're having to take in these massive withdrawals that hit you with a big tax bill. You don't want to avoid that scenario.
Danielle asks, is it better to invest in a 401k or a Roth IRA? So Greg, what do you think?
Well, how about a compromise? Can we say Roth 401k? A lot of employers do offer that Roth option, and Roth meaning you contribute after tax dollars. The difference is, the analogy I can give is the snowball rolling downhill, right? With a pre-tax traditional 401k or traditional IRA, you're getting your tax break at the top of the hill when the snowball is this big. With the Roth, you're getting your tax break at the bottom of the hill where that snowball is the size of a car. Right? So I'm a big fan of, if nothing else, just diversifying your tax exposure by utilizing the Roth. And because the contribution limits are higher on a 401k than on an IRA, if you had to choose and your employer offers the Roth 401k option, go with that one. But there's no reason you can't supplement your 401k with an IRA. So for example, if your employer doesn't offer the Roth 401k, you can contribute to your 401k enough to maximize the employer match, and then do the Roth IRA in addition to that.
Another 401k question from Lynette. She says, I'm wondering if it's smart to cash out on my 401k due to this, the COVID situation in order to pay down her debt and to have money for a down payment for a first time home. They're offering a 3% penalty versus 10% penalty. I don't know exactly what that means, but Greg, what are your thoughts on that?
I am not a fan of that. Let's leave retirement money for retirement. Americans are, generally speaking, undersaved for emergencies and retirement. And looking at the retirement account as kind of that found money, or that piggy bank, is one that's going to bite back later. That has long-term consequences. And unfortunately, in this economic environment where so many millions of people have lost jobs, they've had to resort to that. But to pay down debt, to make a down payment on a home, leave the retirement account for retirement. Accumulate the savings that you need for the down payment. And listen, there's plenty of low down payment loan programs out there, right? You don't need to save up 20%. You can get a mortgage with 5% down, 3.5% down, and there are even some no money down. I'm not a huge fan of that, but they do exist. And as far as paying down the debt, look, I think you got to address where that debt came from first. You kind of put your nose to the grindstone in terms of funneling extra cash towards that debt, get that knocked down over time. Leave the retirement account for retirement, but getting that debt paid off is also going to be a deterrent to incurring debt down the road.
T. Woodard asks, how much would you recommend investing in a 401k when there is no employer match?
Well, I would look at both your ability to contribute to the 401k as well as an IRA. If there's no employer match, then I think you look at the fees in that 401k in terms of making that decision. I'd still be, regardless of the employer match, I'd be in favor of putting as much money into tax advantage retirement savings as you can afford to do. Where you split that, I think, is going to depend on things like investment options and fees. And if that 401k plan, if it has lousy investment options, if it has high fees, then you want to max out the IRA first. If it's a competitively, priced 401k plan, by all means, keep funneling money in there. Even without the employer match, you're still getting the benefit of tax advantage growth and contributing by payroll deduction.
Okay, well, we're about to wrap up here. There were a lot of questions on the refinance fee. Brandon asks, what's the deal with the December 1st deadline? So Greg, just as kind of like a parting thought, like what are you watching for with this fee, and what is the one thing that consumers should know?
Well, the one thing that consumers should know is that when it comes to refinancing, act sooner rather than later. And the reason being, not just our mortgage rates at record lows, but avoiding that 0.5 percentage point fee means getting your loan closed in advance of that December 1st deadline. What's going to happen is, as we get closer, particularly once we get into October, more and more lenders are going to have that fee reflected in their pricing because of the time it takes to close, right? They're not going to, if there's a chance they're not going to deliver that loan until after December the 1st, that, they're going to price loans accordingly, reflecting that fee. So acting sooner is really going to be your best strategy to get in under the wire and avoid that fee. And oh, by the way, you're taking advantage of record low mortgage rates in the process.
Absolutely. All right. Thank you all for joining us for this webinar. I hope you benefited from the advice and were able to take something away from it. And we answered a lot of questions there, some we missed. If you want more news and resources to help you along your financial journey, be sure to sign up for a Bankrate account. You can go to bankrate.com and it's in the top right corner and it just says create account. With an account, you'll get access to personalized articles, recommended calculators based on your interest in daily rate trends, as well as a mailbag feature to submit your questions to our experts like Greg and some of our others. So again, go to bankrate.com and hit create account in the top right. If you want to follow us on social media, we are at Bankrate on Instagram, Facebook, and Twitter. Thanks again for joining us, and have a great rest of your week.